Well, all right. Hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. This is the first time I've shown a video since October 23rd, when I gave a warning about this very long trend that started in 1929, or after the 1929 crash. And the trend is still there, and it's still dangerously precarious if you're in a 401k or a long-term hold investor, buy and hold investor. And so the warning continues, although I was wrong about the timing, and I'll speak to that in just a second. But before we do, I just want to cover again the basis for this warning. This is more or less a completed trend up into here, and the starting point was way back here in July of 19. Let's see, what does that say? July 1932 to now. And incidentally, today is December 18th, about 8:15 p.m. Central Standard Time. So a pullback from this trend could go at least to here, and then it could go as far back as here. Okay, so we'll just have to see. Now, my initial estimate is that it goes down to this area, right around here. This is the S&P 500, by the way. So right around here to 2,000 points on the S&P 500. So basically, a little bit more than cut in half, about a 60% decline. Then we should get some sort of rally, and then we should have another decline down into the 600 area, 650 or so on the S&P. Then we'll get another rally, and then we should have another decline, maybe somewhere between the 1987 low and the 1975 bear market low, somewhere in between this. In fact, let me just draw it on the screen. That will make it easier. Somewhere between here and right there. So it's interesting how these boxes get bigger and bigger, right? That's because the degree of trend that we're retracing gets bigger and bigger. So that's not unusual. Now, what I want to do is I want to go back to like a weekly, and I just want to zoom in on what I was showing you guys and why I was sounding the alarm. Now, I've marked on the chart here this arrow and the price. The price was 42.17 when I was calling for panic, not panic, but a warning. And of course, we're much higher than that. We're now up around 47.40 according to today's close. Still below the all-time highs, but significantly higher than the 42.17. So why was I calling for a top in the market? And I still am, by the way. Well, it's because of these, because what I saw here, there's a model that a guy named R.N. Elliott developed, and it follows 5 waves. Now, there's one caveat to this particular 5-wave move, which you can see here. I'm tracing out for you. This is very overlapping. Okay, so this is a diagonal type move. So if this was a downtrend, this would have to be a diagonal, which it could be. I mean, it looks like a diagonal, right? If I was to draw a line, let's say here, and then another one here, that's kind of an expanding diagonal, right? And then what you get is a lot of overlap. So this is very overlapping. This is very overlapping too, but this doesn't appear to be a diagonal. A diagonal is the only type of overlapping pattern that could still be in the direction of trend. So we really don't have that. Now we do have a little overlapping pattern here, which is another reason why I was calling for a sell-off. But you can see that this is overlapping. So essentially we had excuse me, two diagonals, kind of forecasting that the trend was going to be down. Okay. Now, this is kind of why I was sounding the alarm, right? Um, I did expect a retrace, but something more like I was expecting something more like this, something very overlapping, and then a follow through to the downside like this. And of course, that didn't happen. But technically, this all still could be in a downtrend, um, even if this retraces 100% of this move. So 100% would be right up in this area. Now, here's where things get a little crazy and where I need to explain. There's a lot of divergences in the market right now. The Dow, for example, has already broken above this level, which is created a bearish divergence. I mean, what does that mean that it's that high? And I'm going to show you some charts a little later on that show the Dow divided by the PPI, Producer Price Index. Essentially, the idea is that the market is so narrow right now, with about 7 to 10 stocks that are peaking and starting to roll over, but they were the leaders, that the market has this strange look to it, right? It doesn't look right. And there's no way to know for sure if that's accurate, right? This is just me talking about what I know about the market, which some people know more than I do. Okay, I'll just state that for a fact. But I watch this pretty carefully, and there are things that you just notice over and over again, like the market makes the same kind of squiggle moves at every degree of trend, whether it's a huge trend or it's a very small trend. We could zoom in on a very small trend, and I could show this to you, right? We could go to like a 5-minute chart, and you can see here we get kind of an ABC move. Over here we get something looks more trendy, trending like, but this happens at every degree of trend. So let me go back to a weekly real quick. So to me, the market is still very bearish, and what's driving that for me is a lot of the internals. The bearishness has never been higher. The bullishness has never been higher. There are more market participants now than ever in the market. Roughly 58% of the population is now invested in the market. This is an all-time high record. And when you get all-time high records or all-time low records like this, they're usually indicative of inflection points. And I'm going to show you some more in a minute. In fact, we're going to go to that right now. What I did is I put together a PowerPoint with just some charts on it that shows some of these really extraordinary kind of situations. And I didn't want to do that. I just want to go straight to the presentation part. So, this is kind of the model, the picture, like what you would want to see if your market stance was like mine. This is kind of the textbook bear market top, and this is the Russell. And so, what you'll see in a minute, you'll see over here on this chart. This is the Dow divided by the PPI, and I want you to see how similar this looks to this over here. This is just the Russell 2000 price action. This is the Dow divided by the Producer Price Index. So taking inflation out of the picture, which tells you've had a lot of inflation, right? If the Dow's at new highs, of course we already know that. We already know that we have a lot of inflation. But sometimes these parameters like inflation can change the way the market looks. And that's what I'm trying to tell you is the situation right now. All right, this is the next chart. This is the VIX. Now the VIX is a derivative of a derivative. So it's not something, I mean, some people trade it, but it's not something most people trade. But it is something that people look at because it indicates how much fear there is in the market. And it's inverted right now. Normally, the VIX is at all-time lows. You can see here that the scale is inverted, but it's shown this way to show that there's no fear, like no fear of heights, I guess is the way they've shown it. And all these charts are by Elliott Wave International. So these are not my charts; these are their charts, and they track all this stuff all the time. But you've got this, you know, the fear has not been lower in the last 4 years than it is right now. This right here was the COVID sell-off. That's what you're seeing right there. Just to contrast where we were. So, I mean, the VIX was like at 90 during the COVID sell-off. So much higher. This is just stocks, the overvaluation of stocks in U.S. equities. So we're looking at the U.S. versus the rest of the world here, and there's a lot of money pouring in the U.S. and some of this is overseas money, and it's driving stocks higher, right? But when you get extremes like this is a lot of times where big turns in the market take place. The Nifty 50 was kind of like today, except it was 50 stocks, not 7 or 10. And this was a time where the market was very narrow, and you can see that it corrected. This is the internet bubble, and the internet bubble was like the biggest bubble of all time, right, at that time. But now we've got this new bubble, which is kind of stocks and bonds. This is an interesting chart. They've been tracking this one for some time, but in 2021, valuations based on book values and dividends was way up here. They were calling this the Pluto chart. So this is like where the historical data normally resides, down in this area. And almost everything above this area is where stock valuations have been since we've gone off the gold standard. Okay, that's what all this stuff up here is. But you can see up here, this 221, this is why they call this Pluto's, because it was so far, like this being the sun, it's so far away. And you can see our current position is right here. So it's still very overvalued. In fact, when the bear market is over, many years from now probably, we'll probably be somewhere back down here by this box. And that'll be a time when you can just take all your money and push it into stocks and feel really good about that position. This is another interesting chart. This is the like the junk bond yield minus the 3-month treasury. So if you think about it, junk bond yields are usually some of the highest yields in the market. So let's say maybe 6 or 8%, or even 10 or 12%, minus the 3-month treasury. The 3-month treasury might be, normally it might be, I don't know, like right now it's probably trading at 4%. And so if you think about it, 12% minus 4%, that's 8%, right? Or in this case, May 1932, you can see here the spread was 12 points, 12%. And at the major top, it was almost zero. And see, we're kind of at that situation right now. We're almost zero, the spread between junk bond yields and 3-month treasuries. And this starts to really shift a lot of money around, because what's happening is people go, holy cow, I'm not making money in stocks. The yields are so low and the prices are so high. Maybe I need to start moving more into bonds. And you're seeing that now. You're seeing money run to the bond market because they think we've hit a bottom. And we have hit a bottom momentarily. I think there's a lot more to go in the bond market, but these are traders, right? Money moves from one asset class to another based on risk and reward. And so you got money now moving into the bond market and most likely leaving equities. Although you wouldn't be able to tell it by looking at the index, right? So that was the last one. So also, you can look at There's all kinds of other internals that we look at, like advanced declines. Like there was one day, I can't remember what day it was, but the Nasdaq was up like almost 200 points, but the advanced decline in the Nasdaq was down. Like there were more decliners than were advancers, which is that almost never happens. When an index is up, the advanced decline line is up, not down. But we just have these strange kind of things going on in the market. Now, what I want to do is I want to zoom in on this chart a little bit because I just want to show you. Well, um, let me go to the futures because I've been looking at that more carefully. This right here, I don't know if you can see it, but it's a 5-wave move. It's 1, 2, 3, 4. All right, 4, 5, and then we had another 4 and a 5. So I think this move is likely over or nearly so. We might get one more little high tomorrow on Tuesday, the 19th of December, but then this should really start selling off. It doesn't have to. I mean, don't get me wrong. This thing could extend. It can continue to extend. But what we do have is we have another possibility for it to roll over and start going down. Because anytime you have the end of 5 waves, you've got a possibility for the market to stop going up and to start going down. And you can see this, I don't know where in here, but somewhere in here there's a 4. And then this was 1, 2, 3 with, and let's see, 1, 2, 3 here, 4, and then 5 extended, 1, 2, 3, 4, 5. So this should be over. We should at least get a pullback into the 47.35 area on the S&P 500, which is not that much really, 60, 70 points. Or it could just start going down and just keep going down. So we'll see. We don't really know, but the point of this video is that if you're a buy and hold person with money in a 401k, my warning really is about how fast this could go down. So let me go back to a monthly and zoom in. So let me do this. Let me go. This is the 2000. I'm going to go back to the 2009 low. So here's the 2009 low here. And notice how it looked a lot like the 1932 5-wave trend. In fact, let's just look at that. Let's look at the 1932 one. Let me go back to the SPX. Because I always think this is one of the most interesting things about the market. This is what I mean by the market is a fractal. So this is the 1932 low. You can clearly see a move up, a move down, a long move in a wave 3, a 4, and then a 5, right? Now, let's just go to, where is it? No, here it is, 3-week. No, that's not it. Which one was it? Let's go to the 20-year. Okay. So here's the 2009 low right here. Of course, I don't have it drawn, but it doesn't matter because it doesn't matter if I'm gonna draw this or not, but you can see that, there's a 1, 2, 3, 4, this is all 4 and 5. And then if I zoom in here, you'll see this, a very similar thing. You'll see, although it's harder, right? Because it's more compressed. It's always easier to see the further you go out. In fact, if you can't see what you should do in the market, you should just always zoom out and look at the bigger picture. The bigger picture is what will tell you where you need to be. So let me zoom out and let me just talk about, let me go back to the monthly because let me go to this monthly and zoom in from there. So I'm going to compress this a little bit because here's the COVID low. So at a minimum, I think what you'll see is you'll see something that and I'm just gonna draw it that way. It'll be easier for you to see, easier for you to understand. So if this is the top here, okay, we should see some sort of move fairly directly into this area, okay? Which is pretty significant. That's 3,300 or so. And then we'll get some sort of retrace that looks like this, although it won't be very deep like these last ones. It should be fairly shallow like this. And then we're going to see a pretty hard move down into this area like so, okay? And then we'll see probably some other, another type of retrace, which could be a triangle. Sometimes you'll see triangles like this, okay? And then you get a sell-off like that. So this is what the first wave of the bear market should look like, okay? And it may not even give you this much of a retrace. So my point is, sometimes it moves so quickly that it doesn't even give you a chance to, say, well, maybe I should get out. You just stay in and you end up holding. And so this is going to be, this should be cut more than in half. In fact, let's just measure it just to see. So from here down to down into this area, that is 57%. So we're talking about a pretty big decline, and that is something that is worth a warning. Whether it's right or not, certainly the market. Let me just say this. Here's what I can tell you almost for sure. And I can't make any guarantees, right? There's no guarantees in the market. But when you have something like this, you don't start a new bull market from here, okay? You start a new bull market from down here or even down here. You don't start one from here. So even if you sell here and it goes up another 2 or 3%, but then it goes down 58%, you really haven't lost anything. So just be careful. It's your money. You get to decide what you do with your money. But I'm trying to explain, kind of a justification why you should be hyper vigilant about what's going on in the market. All right, with that, I'm going to go ahead and end. Thank you for coming in this evening and listening to my video. Again, it's your money, no guarantees. You get to decide what you do with your money. But I do appreciate you coming in and listening. And if you have any questions or comments, just leave them in the comments section, and I will get back to you if I can. All right, thank you.